Happy Thursday, everybody. Welcome to the Liberty Call. I am Raymond Dahlman, your humble host. It is April 25th, 2024, and the Astros are on TV right now. They have lost the first two to the Cubs in spectacular fashion, and they're holding on to a 1-0 lead right now in the top of the sixth. So I don't have much hope. They're playing like dog poop right now, so is what it is. Anyways, market's not much better. Ugly day in the markets. Woke up to the markets or the futures in the tank, and the market went with it. So not really surprising. So, all right. Well, if it is your first time watching Liberty Call, if you could do me a favor. If you could give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell. All right, let's go ahead and jump over to today's indexes and see how they turned out. Dow Jones was down 0.98%, 375 points, closed at 38,085. S&P 500 down 0.43%, closed at 5049. NASDAQ down 0.64%, closed at 15,611. The VIX was down 1.06% today, it's at 1580. Canada up 0.05, Brazil down 0.2, and Mexico up 1.23%. Over in Europe, Germany was down 0.91%, the UK up 0.48%, France down 0.93%, the Netherlands down 0.43%, Spain down 0.4%, and why is someone bothering me right now? I'm in the middle of a broadcast. Where were we? Spain down 0.4%, Italy down 0.97%, same with Switzerland, and Portugal up 0.19%. Russian exchanges both in the green today. The MOEX up 0.38, the RTSI up 0.7%. And the Asian markets, the Nikkei in Japan was up 0.04. Australia looks like it was closed. New Zealand down 0.02%. In China, the Shanghai was up 0.27%. The Shenzhen component up 0.14. China A50 up 0.52%. DJ Shanghai up 0.21%. Hang Seng up 0.48%. And the last time the Taiwan weighted closed, it was up 2.72%. All righty. So, markets domestically were in a nasty mood. And probably has something to do with some of the data we're going to cover a little bit later. Could be, maybe not. I don't know. All right, let's get to the market recap. U.S. stocks falls as Meta slump rattles tech, sticky inflation jitters persist. Inflation, the bad word. On Thursday, U.S. stocks experienced a decline, primarily influenced by Meta and a surge in Treasury yields, reflecting fresh economic data signaling a slowdown in growth, but persistent inflation. What do we call that? Stagflation. Yeah, remember the 70s? I was a little tight. I wasn't dealing with that sort of stuff. I was more worried about Star Wars and all that sorts of stuff. This prompted traders to postpone expectations for the first rate cut until December. Remember a few months ago, or late last year, they were talking about March? Yeah, that was last month. And then they were like, well, maybe not March. Maybe it'll be in, God darn it. Maybe it'll be in June. Yeah, probably June. Yeah, June, definitely July. Yeah, is there a July meeting? Yeah, there is a July meeting. Definitely by then. Now they're talking about December. And again, like I've said hundreds of times probably on this broadcast, is that I don't think the Fed's going to do anything until there's a reason. And the reasons would be either, the job market falls to crap or the stock market goes to crap. I think it's probably gonna be the stock market, but it could be one or the other, and they'll both affect, they both affect each other, because they work together. All right, where were we? The market sentiment was dampened by Meta's underwhelming second quarter revenue forecast due to increased spending on artificial intelligence, leading up to an 11% drop in its stock value. Let me stop there again. Yeah, I noticed over the weekend that on the Facebook app, it now has a little blue circle for asking questions to AI. And I asked it like 5 different times, is Mark Zuckerberg a robot? And it, first it's like, ha, 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 it laughs. And I just kept asking it over and over again. It's like, well, he is kind of robotic. It's like, is he really a robot? We don't know. All right, back into the news. This projection overshadowed the company's better than expected first quarter earnings and set a somber tone for upcoming reports from tech giants like Microsoft and Alphabet. Additionally, IBM's disappointing first quarter earnings, coupled with its announcement of a $6.4 billion deal to acquire HashiCorp, contributed to a 9% decline in its stock. Despite strategic potential highlighted by analysts. This move by IBM was met with skepticism in the market. Caterpillar also experienced an 8% drop in its stock price following mixed first quarter results, which were exceeded expectations, but revenue fell short. Similarly, Ford saw a 2% decline despite reporting stronger first quarter earnings and positive cash flow guidance, with weakness in its EV sector offsetting gains in its commercial division. On a brighter note, Chipotle Mexican Grills stock rose by 6.5% after surpassing earnings expectations in the first quarter, attributed to menu price adjustments. Rubrik Inc. made a notable debut in the market, with its stock soaring 20% on the first day of trading after pricing its IPO at $32 a share, opening at $38.60. Overall, the market's response was influenced by a blend of disappointing earnings reports, strategic acquisitions, and successful market debuts against a backdrop of economic data indicating slower growth but persistent inflationary pressures. Not good. All right. Well, let's move over to dive a little deeper. The GDP initial number came out for first quarter. Let's see what has to be said there. All right, today's GDP report is likely to disappoint the Federal Reserve, as real GDP growth in the first quarter fell short of expectations, registering a sluggish 1.6% annual rate, notably lower than the anticipated 2.5%. Shocking that analysts were off. This marks the slowest growth in nearly 2 years and diverges from forecasts of all major economic groups on Bloomberg. However, government purchases, inventories, and international, I skipped something. However, attention should be directed towards the core GDP, which excludes volatile factors like government purchases, inventories, and international trade. Core GDP fared better, rising at a healthy 3.1% rate in Q1, driven by consumer spending, business, fixed investment, and home building. Despite this, inflation remains a significant concern, with GDP prices, personal consumption prices, and core consumption prices all showing increases above the Federal Reserve's 2% target. Nominal GDP, a combination of real GDP growth and inflation, rose at a 4.8% rate in Q1, indicating a tighter monetary policy has yet to exert significant influence. Consequently, short-term interest rates are likely to remain elevated for an extended period, maintaining the risk of a looming recession. Who's been talking about that? This guy. Some analysts attribute ongoing economic growth to a supply-side boom fueled by AI and other innovations, but this would typically suppress inflation, which is not the case. Instead, the economy seems to still be under the influence of loose monetary policy, which sustains both growth and inflation. In contrast to the GDP report, there's positive news on the job front, with new claims for unemployment insurance declining by 5,000 last week to 207,000. While continuing claims dropped 15,000 to 1.781 million. This suggests ongoing job growth in April, providing a counterbalance to the concerns raised by these GDP figures. Not good, not good, not good. Well, I mean, the jobs numbers are still good, but like I said, jobs numbers are a lagging indicator. You probably really won't see a lot of layoffs or unemployment creeping up or any of that sort of stuff. Until businesses really, feel the pinch in their wallets, and that's when they'll start slashing payroll. All right, one last article here comes from Zero Hedge, titled "Wall Street Reacts to Today's Stagflationary Data Dump." All right, the latest GDP report sent shockwaves through Wall Street, particularly due to stagflationary concerns and unexpected data points. Despite expectations, the GDP print fell below even the lowest Wall Street estimates, exacerbating worries about stagflation. Core PCE inflation came in higher than anticipated, adding to the unease. Key figures in the financial world have weighed in on the implications of these developments. Ian Lingen of BMO Capital Markets highlights the uncertainty regarding potential revisions in tomorrow's core PCE report. Bloomberg's Ira Jersey emphasizes the significance of the PCE deflator in the bond market and sets a technical level for Treasury yields. Sebastian Boyd of Bloomberg suggests two interpretations for bond traders: weak economic growth versus unexpectedly high prices. Lindsay Rosner of GSAM Goldman Sachs notes the Fed's likely prioritization of inflation concerns over GDP softness. Quincy Crosby from LPL Financial sees the GDP report possibly altering the Fed's rate easing timeline. We just talked about that a minute ago when they said December might now be the earliest that we would see anything. Dan Suzuki of Richard Bernstein Advisors finds some encouragement in investment spending, despite weak areas like government spending and exports. Edna Curran of Bloomberg sees potential implications in the slowing economy, especially with an upcoming presidential election. Rubila Faruqi of High Frequency Economics points out the uncertainty ahead, balancing labor market strength against potential headwinds from delayed Fed rate cuts. God darn it, now it's a tie game. Olu Sonola of Fitch Ratings warns of significant impacts of high inflation despite slowing growth. And Jan Hatzus of Goldman Sachs breaks down the GDP composition, highlighting strong domestic demand despite misses in inventory and foreign trade. Alan Detmeister of UBS acknowledges the complexity of interpreting this data and its implications for future assessments, particularly regarding core PCE price changes. Overall, the mixed signals in the GDP report have sparked intense scrutiny, which we've just covered, and speculation about the economy's trajectory and the Federal Reserve's response. So basically, no one knows what the hell's going on. I think that's probably the best thing. The talking heads on TV are just yapping so that they can, have something to talk about and, drive ratings. In real life, things are a mess. There's way too much federal spending. I mean, that's where I would start. Stop spending, just basically shut down the federal government, pay off the debt, and, let the American taxpayer regroup and put some money back in their pockets. But, that's just me. What do I know? I'm just a financial advisor. Anyways. All right. Well, that's everything I had for today. If anyone needs anything from me, go to dsafinancialgroup.com. All my confirmation or all my contact information is there. I hope you have a wonderful evening, and I shall talk to you next time. Adios.